Today, March 24th, 2026, the US stock market entered trading cautiously, following a strong rally the previous day. Futures indices such as the Dow Jones, S&P 500 and Nasdaq all saw slight corrections, reflecting investor sentiment in the face of lingering risk factors. To understand today's developments, we need to look back at the overall market picture in recent sessions. In the previous session, the market experienced a rather impressive surge, mainly due to positive news related to the easing tensions between the US and Iran. As the risk of war decreased, oil prices also cooled down, leading to lower inflation expectations and creating conditions for a strong recovery in the stock market. However, this upward momentum was quickly challenged by new information from Iran denying any negotiations with the US. This shook market confidence as it showed that the geopolitical situation was still unstable. And in the current context, global financial markets, especially US stocks, are extremely sensitive to geopolitical factors, particularly when they directly relate to energy supply. One of the most important factors currently influencing the market is oil prices. As oil prices rise in the Middle East, the risk of supply disruptions is causing oil prices to rebound. Rising oil prices not only affect the production and operating costs of businesses, but also put significant pressure on inflation. With the risk of inflation returning, the US Federal Reserve Fed will face difficulties in deciding its monetary policy. In fact, market expectations that the Fed will soon cut interest rates in 2026 are gradually weakening. If interest rates remain high for an extended period, the cost of capital for businesses will increase, while simultaneously reducing the attractiveness of compared to safe haven assets like bonds. This is one of the major factors preventing the stock market from forming a sustainable upward trend. Besides macroeconomic factors, investor behavior also plays a crucial role in short-term market movements. After a strong rally, profit-taking pressure is perfectly normal. Many short-term investors will take advantage of the rally to realize profits, thereby creating selling pressure in the next session. This contributed to a slight market correction today. From a technical perspective, the S&P 500 index is currently approaching short-term resistance zone. This is an area where strong selling pressure has occurred in the past, preventing the market from breaking through on several occasions. As the price approaches this zone, cautious sentiment will increase, and even a single piece of negative news could cause a market reversal. The current market trend can be described as a tug-of-war with wide fluctuations. Ups and downs are alternating, reflecting a lack of certainty in the trend. The market lacks sufficient momentum to enter a strong growth cycle, but also hasn't presented enough negative factors to lead to a downward trend. From a sector-by-sector perspective, energy-related stocks tend to benefit from rising oil prices, while interest rate-sensitive sectors like technology or real estate may face pressure. However, the current divergence is quite pronounced, and capital flows are not heavily concentrated in any particular sector. In the medium term, the market outlook remains somewhat positive. The US economy remains stable. The labor market shows no clear signs of weakening, and many large businesses are still reporting favorable results. In particular, sectors related to technology and artificial intelligence continue to attract long-term investment. However, risks remain and cannot be underestimated. Factors such as inflation, interest rate policies, and especially geopolitical situations will continue to be important indicators affecting the market in the coming period. Just one unexpected change in these factors could quickly reverse the market trend. For investors, this is a period where risk management should be prioritized over short-term profit-seeking. Chasing rallies during sharp increases carries significant risks, while a strategy of gradually increasing investments during market corrections will optimize entry points and minimize volatility risk. Furthermore, closely monitoring macroeconomic information, especially developments related to oil prices, Fed policy, and geopolitical situations, will be a key factor in helping investors make more accurate decisions. In summary, the US stock market is undergoing a minor correction today, after a strong rally, with the cautious sentiment prevailing. The long-term trend remains unclear and heavily dependent on external factors. In this context, Patience and discipline will be key for investors to survive and capitalize on opportunities. When the market becomes clearer,